What is up, everybody? Welcome back to the channel. Today we have some very exciting news. We have the markets crashing. We have Trump tariffs. We're going to go through all of that today and see what's really pushing the market down and why the market's going down. We're going to look into some stocks as to why those might be dropping and look into some valuations of some stocks. So we have an action-packed video today. We're going to go into this article here, this headline right here saying that Trump tariffs, if sustained, will likely push down the US and the globe into a recession. That's by JP Morgan. Now, they're going to try to raise this effective US tariff rate to 25%, and that level would hurt the US growth and inflation outlook, according to JP Morgan. We already know that Trump has this scheme and semantics of going to push tariffs higher. And with the tariffs going higher, that not only gets passed on to the consumers, but it gets passed on to the companies as well. And corporate profits may drop if not passed on to the consumer. Following that, look at the market today. You have so many companies just dropping like flies. You have Microsoft down 2%, Apple down 8.5%, Amazon down 8.5%, Google down 4%, Meta down 8%, Nvidia down 6%, Tesla down 7%. You see sectors just bloody today. And what that really means is we should really be going out there and getting into these companies if given lower valuations. So now that we're given lower valuations, I think that only some of big tech is trading at great valuations. Others might be more expensive, according to some other people might say. I like companies that are going to be here forever, not forever, because we can never say forever, but that are going to be here for a very long time, that have really strong moats, that have really good businesses and cash flows to support that. So an example of that would be Google at 4% drop. At 4% drop, Google is pretty intriguing today, $152 a share. And if we just go over to this site here and look at some visualizations of Google's stock and how they're performing as a company, we're going to look and see that the cash flows year over year, they've just been almost consistent. We've seen a little drop, but they're coming back. Revenue's been slowly and steadily increasing, and they've been able to buy back shares. We love to see companies buy back shares because that's the money going back into our pockets. And why not? Why not be happy that they're returning value back to shareholders and giving that money back to us? So overall, Google trades at a PE meaning price to earnings ratio of 18.9. And if we look at this PE, we can see that, not even 5 years ago, they were trading at 28. And today they're trading at 18.9. The valuation has dropped immensely. But if you look at the business overall, we have been growing. The business today of Google isn't the same that it was 5 years ago in 2020. Now, there's so many things going for Google. Some people might be scared of, oh, what if they have to sell off the Chrome business? Or what if the market just doesn't like Google? Overall, there's so many good things going for Google. I don't think the search is ever going to be replaced. And they have so many other initiatives like Waymo. Waymo is one of those companies that are just going to be a beast, and Tesla is going to compete with Waymo in order for share in the autonomous driving network. So overall, there's so many good things going for Google. I like Google overall. If you come back to this free cash flow yield here, you're looking at a price of free cash flow of 25.9 and a free cash flow yield of 3.9. So that is pretty healthy for the company itself. Another company that's been dropping like crazy that you might want to look a bit into is Meta. Let's look at big tech Meta. Typing Meta into here, you can see that revenue's been increasing steadily. Free cash flows have been just insane for the past couple of years. The PE is at 22 today. And, this company has been dropping in terms of valuation. It did drop hugely in 2022. If you were able to scoop up Meta shares at sub 100, then that would have been the best time ever. However, the Meta business has just changed so much more than it has in the past couple of years, because Mark Zuckerberg has really pulled back on that metaverse, and he really wanted to focus down on the core business of Meta, that being advertising and what it is today. So P ratio, you're looking at 22, and that is just not bad for considering that they're growing top line at 20% a year. Meta is also able to buy back their shares every single year. And we love to see that as a company because you're getting that money back into your pocket. Net income just overall just straight steady line going up ever since 2022, 2023. If I had more money to deploy, I would put it in Meta. Today, this is what I did. I put my money into Google. I was able to sell out of a JP Morgan premium equity fund that, they sell covered calls, and that's premium and that's income for many people to reap. But I found that I should probably rotate that money over to Google because there's a better opportunity here given the lower valuation that's I've been given today. And why not take advantage of that? Another business that we can look into here that has been dropping immensely is Amazon. Amazon at a $2 trillion market cap, you're getting at a price of 196. Top line has been growing at about 11 to 12% every single year. Free cash flow has really turned around for the business ever since 2022, 2023. You can see this really U shape right here that we're coming back in free cash flow. Overall, if you look at Amazon, it might look a little expensive at 34 PE. However, Amazon has always traded rich. Amazon's one of those companies that, for the history of time, you can never get this company for super cheap valuations under 20, under 30. It's very difficult. Looking at the PE ratio here, just in 2020, this PE ratio was 90. And if you look at the peak of the PE ratios, when earnings did drop, like net income did drop here, so PE did skyrocket up to 240. But if you look at the business just over the past 5 years, you're able to see that we went from a 90 PE all the way down to a 35. These are record low PEs, and imagine how much the business has changed in Amazon ever since 2020 to 2025 today. I gotta say, it's a huge difference of what's happened. So when we're granted these lower valuations here, and we're seeing lower valuations within the companies that we love and that are going to be here for years and years on end to be here, just because we have, tariffs might be coming and that's going to scare everybody out of the market. If we're getting a good valuation of Google at a 18, 19 PE, why aren't we taking that? That's something that we have to ask ourselves. Because what if we don't get this valuation again? I feel like we should be averaging down, or I am at least averaging down in Google to try to get my cost basis as low as I can and build out a position for myself. It's a very early position for me, but it's about 5% of my portfolio today. So with that being said, I hope you guys are buying stocks today, and make sure that you guys take advantage of these deals that we're seeing in the market, because who knows, maybe we'll get better news and maybe the stock market might go back up and we might renegotiate terms with tariffs. Who knows, right? Because these tariffs are pretty hefty, and a lot of people might be saying that the government is failing us and the stock market's going to fail and we're going to go into recession. That's not the way to think, guys. I think we should be buying equities, buying stocks, and making sure that we are planning for our future, buying the best companies that are going to return money back into our pocket. Make sure you guys are doing that. I hope you guys enjoyed today's video. Make sure that you like and subscribe. Comment down below what stocks you bought today in this market crash, market downturn that we're seeing today. Thank you guys for watching this video, and peace out.